Today on the interview with me, Ayesha Faridi, I bring you a global voice who helps shape the world's view on markets and investing. Stephen Dover, the Chief Market Strategist and Head of the Franklin Templeton Institute, leading research and strategy at one of the world's largest asset managers with over $1.5 trillion in assets across the globe. With decades of experience across equities, multi-asset strategy and emerging markets, Stephen has been a key advisor to investors navigating everything from Federal Reserve pivots to trade wars and the reshaping of global supply chains. So as the world debates whether we are heading toward a new growth cycle or a global reset, we ask Stephen Dover exactly that. Stephen, welcome to ET.
Thank you
for your time.
Great to be here.
And I want to start off with exactly that. What lies ahead for the world in this time of tectonic shift or global reset, as you call it?
Well, it's absolutely a global reset. I think that the world that was engineered after World War II, in which the United States was really protecting trade and opening free trade, is ending. And we're going to a world of probably more regional trade, a world of high technology. We just had the Nobel Prize happen just about 3 weeks ago, really talking about how the world progresses, and we have to increase productivity. We have to have a great degree of creativity. But the real big thing that they said is there's a lot of creative destruction, and that's really what we're going through.
Innovation, right? Like we were talking about. That's where the seeds are sowed. Where do you think in the world is innovation happening, and who's going to lead the race eventually? I know it all emerges from the US, and it seems like it's going to be US, which has dominated so far. But then there is China, there is India, there is so many economies, so much brain power at work, innovating pretty much on a daily basis. Who's going to win the race according to you?
Well, innovation's complicated because it's individuals, it's structures that allow, especially now, structures that allow for innovation, and it's the governments that support innovations. I think, of course, there's been a lot of innovation in the U.S., and the U.S. as a country has structured itself in that way. But I think there's also, if you will, a little bit of hubris in the United States, that all innovation comes from the United States or comes from the West. And what we're seeing, and I think it's a real surprise to Americans in the West, is exactly what you said, a lot of innovation coming out of China. The whole idea that somehow the West missed that if they have things manufactured in China, that China's not going to innovate and move up was a big miss on the part of the West. And India, too. I think India is inherently an innovation culture.
So far, what are the signs like? Who's going to actually lead the race?
Well, I think the signs are a bit mixed. Certainly, if you were to look back over the last 20, 30, 40 years, you wouldn't have guessed the United States would be where it is. You kind of certainly went through a long period of malaise, which was a term our president used at one point in the United States. So it's been a bit of surprise what's happened in the United States. But it's also been very much a surprise what's happened in emerging markets, which when I was younger would have been called third world countries because there was just no possibility of them. I'm quite proud that my company, Franklin Templeton, and our leaders at the time were leaders in developing the term emerging markets and really leading the charge, saying these are the countries of the future. And that's where I think we're going to continue to see a lot of opportunity. Emerging markets haven't been emerging as much as we had hoped they would over the last 5 or 10 years, at least in terms of earnings. And so that's made them less positive investment opportunities than they were in the past, with India being an exception to that.
So what is going on from an investment perspective in India? Because from what I see in the last 13 months, there's been an FPI exodus. I mean, you could talk about valuation, you could talk about relative plays, other countries looking cheaper, China being one such case in point, or for that matter, the earnings sort of peaked out. Yeah. Well, what do you think will make the FIs come back to India?
Well, I think you have to look a little beyond the 13-month story because India was so far ahead. India was such a standout among the emerging countries. So first of all, just a bias that I have and Franklin Templeton's had is that by and large we have broad emerging market funds and investment strategies India is one of the few country strategies we have, and we've been quite bullish on India for foreign investors since I arrived. And we were one of the first companies to set up funds for retail investors to invest in India. So we are, and I think we will continue to be quite positive on the India structural story. So when I look at India, or when I'm advising foreign investors, I'm trying to look at the 3-5 year story. Yeah. So I think India kind of got ahead of itself, and then there were other relative plays where capital has gone, including the United States. And so I think that's the main story of India, and I think that will turn around as there are more opportunities in India. But I think India, in some sense, became a momentum play within emerging markets. It went from kind of being underweight to being kind of heavily overweight, more expensive relative to others, and so there was a leveling out there.
Well, when you talk about US, you think the equity dominance is going to stay? And why I ask is because there too, there is that concentration pool with the Mag 7, and a lot of concerns also around the bubble or the threat of a cool-off that it actually poses. Now with this entire Trump tirade at play, the tariff dynamics at play, the Fed finally, changing curve at play, and of course, the cool-off that you've seen in the dollar, how do you think that dynamic is going to play out for U.S. equity?
Every time that central banks have cut interest rates after they previously cut interest rates and the market's expanding. So that's happened 7 times in the last 50 years. Every time, 1 year later, the market has been higher. A lot of turbulence. We expect a pullback. Wouldn't be surprised. The market seems pretty fluffy right now. Wouldn't be surprised if we have a pullback of 5, even 10%. But we think in a year's time, the market's likely to be up. The other interesting part of that is risk assets do better. So we think, and that's the first thing that we have broadening, we think that it's likely that the stocks beyond the Magnificent Seven will start to perform. But importantly, and for about a year now, we've also been recommending to American investors to invest outside of the United States with our other 2 themes, that we think the yield curve is steepening and we think the dollar is likely weakening. And that's why Europe has outperformed. Emerging markets have had a good year, and as has other developed markets.
So when you say outside of the Mag 7 pool, do you also sense that that pullback could also play out for Mag 7? Because they're the only ones which are, performing, and their market caps are higher than some of the country GDPs.
Well, they are. They're not the only ones outperforming, though. Actually, overseas markets have performed about as well as the Mag 7. Part of that's taking the dollar into account, of course. So for a dollar investor, and even though they haven't performed as well as the Mag 7, many different indices are also at all-time highs. So again, you have to take risk into account as from an investor point of view and say, yes, the Mag 7 probably are going to do very well, but how much risk do you want to take in that high concentration?
It's not just about a regional play here. We're talking about multi-asset classes, because what a unique time when everything from crypto to gold to many other precious assets, it's a multi-asset bull market that we're sitting on across the globe, right? What explains that, though?
Yeah, it's actually very difficult to explain. I think that probably one of it is that we just have a situation in which the reserve banks, in order to kind of stimulate the economy, have done that through asset inflation. And so everything's up. We see that in the consumer numbers, certainly in the United States, but I think globally. So older consumers that have assets are doing great. Consumers that don't have savings and are just trying to earn things are really hurting. We see that around the world. Again, that explains, at least to some degree, some of the political situation that many of our countries are in. The correlation of assets is troubling and very difficult to see something that diversifies. But India, from a foreign perspective, has been a country that's had a lot of diversity in terms of its economy. India would be a country that really shows that old saying that the economy is not the markets, right? The Indian economy is really not a technology economy, but that is what, it's overweighted in the market. So that, again, argues even in India that you'd want to broaden your investment base. You'd want to pick a wider range of equities than just really focus on this narrow group that's done so well for so long and may very well continue to do well. But there's a risk involved in that.
No, I mean, the question on why multi-assets are also doing well also arose from the fact that, typically or traditionally one would think is that gold is a safe haven asset. There are geopolitical risks around the world, and maybe that's why, and of course a lot of countries buying gold as well, piling up on that in fact, which is why gold would be doing what it's doing right now. But then what explains the risk on mode in equities?
Well, gold's a funny asset. It's very difficult for an asset manager like me because the way I typically think is anything that has a discounted cash flow I can value, and gold, inherently doesn't. As you alluded to, I think a lot of the rise in the gold price is Russia and China and other central banks buying so much gold. I think it's been a very overcrowded trade. What it is not indicating is a concern about inflation, because that's not reflected in other markets. It's not really even showing geopolitical destabilization. So it's an odd situation. I think we're living in a world where the money supply is increased, and so it kind of makes sense that gold adjusts for that in some way. But the real thing I would say is gold doesn't seem to be the diversifier that it has traditionally been.
So what is the diversifier? Is it a multi-country asset allocation?
Well, everything is more correlated, so very hard to diversify. So the quick answer to your question is yes. Everybody seems to be overweight the United States, and within the United States, overweight the Mag 7. So I am certainly jumping up and down, trying to push people to invest broader than the United States, and certainly broader than the Magnificent Seven. And that you used to do that. One way to do that, you thought, was to invest in indices. But now the indices are so concentrated that you actually would get much more diversity from an active manager or somebody that can,
as opposed to passive,
as opposed to these passive strategies. So then, yes, you need to diversify by country. You need to diversify by asset class. I think that fixed income, as interest rates come down, probably need to have fixed income, but also increase your duration. We are trying to advise clients to be in some private assets. Here in India, it might make sense to be in private fixed income or private equity or private real estate. Real estate is the one thing that has not gone up so much globally, and maybe an asset, especially if interest rates continue to drop, could do well, but it won't do well if the economy isn't doing as much.
You made a very interesting point as to how in today's world we're getting more inclusive, yet at the same time we're getting all interlinked because of AI and the tech evolution which is currently at play. How does India fit into that pool?
Well, I think in terms of the interlinking, I think that...
and AI innovation as well.
Yeah, well, I think India is a very innovative country, and it's part of the backbone for AI, and I think will continue to be. I think a couple big strengths for India are what I alluded to before, is that India just has a lot of efficiency that it can increase. I think you're sitting there with a cell phone, and I think that the cell phone analogy, if I may use that in India, India leaped from no phones to cell phone, right? It didn't go through didn't go through the wireless. And I kind of joke, but it's true. And I travel through rural India. Everywhere I go in India, I have great cell phone reception. In Silicon Valley, believe it or not, we have terrible. You get around the hill, we have terrible cell phone reception.
That, but
it's
if
true.
You say so.
And so I think that's a real possibility for India, not necessarily the AI itself, but the implementation of the AI and a real leapfrog in terms of industrialization and using AI to improve inefficiency. And just my knowledge of working with Indians and the Indian culture is you have a culture that's likely to pick that up pretty quickly.
But where does that leave the traditional IT services play? I mean, one would have thought that they would be the first ones to actually adopt to AI. Yes, many are now getting into data centers, and we have one large IT services company announced that a few weeks back. But do you really think they will be able to catch up on the entire AI/tech innovation?
Well, I think that's a good question, and it is certainly not clear that they will. They could actually be part of the constructive or the creative destruction. So it's really a question. It's interesting. A few years back, we thought that they were actually going to benefit, and now we actually see that AI may be a competitor to them. And I don't know how that's going to play out.
Do you think one is safer when it comes to India to invest in the consumers of AI as opposed to the innovators? Because that's where you don't have clarity right now.
Yes, I do.
Yeah. When you talk about China, and we must address that piece, because part of the outflows from India have also, found their way into China, and it has a much higher weightage now in the emerging market basket as well. Wanted to understand whether that's just a tactical play or is it a structural story from the COVID lows that we've seen in the last 1 year?
I think it's a tactical play, and certainly I think that longer term, the structure of the markets in India is more positive than China. So when I'm talking to foreign investors who ask me the difference between China and India, I say you have to be careful to always know that the economy is not the market. So China's economy has had phenomenal growth, but China's market has had dismal growth. India's economy has had good growth, but India's markets have had phenomenal growth.
Yeah.
Why?
Yeah, why?
Because the economy has translated into revenues and earnings growth in India that in China, they just haven't had a return on their investment in the same way. And if that continues, ultimately, it is earnings that drive equity markets. It's the earnings that drive the productivity. And that structure that India has is incredibly positive for the long-term view.
Well, when it comes to India, and we've addressed IT, but when you talk about sectors, is it banking, financial services? Is it infrastructure? Are those the structurally strong plays, you think?
Yeah, so I'm not such an expert on
just
on
a broad
India
view
in general, but
yeah.
I think that, yes, probably the consumer. I think that the industrials can probably do a lot better in terms of their efficiency. And the growth in India is going to be represented in their banks.
Right. What has been really surprising is the way some of the crypto assets have done.
Yes.
Has that come as a surprise to you, and the kind of now sort of global acceptance that it's finding at global stages, if you will?
Yes. To be honest, it is a surprise to me. And I think partly because as a kind of traditional investor, it's been hard for me to get my head around cryptocurrencies and then to think about how they might make sense in a portfolio. So if you'll indulge me, let me tell you my learning path on that. First of all, with just the blockchain in general,
yes.
I think the blockchain is probably something that will take effect and will have a lot of effect within companies, especially financial services. It's hard to invest in that per se. Crypto is a little different than that. And with crypto, I divided into two categories. The first category, which is primarily Bitcoin, is very similar to gold. It's just an asset that has a value based on whether people think it has a value or doesn't have a value. And so you have to value that in the same way you do with gold. So the first point is then it is an asset that you can value, so it's a legitimate asset to put in your portfolio. Okay. So then the next step is your question, should you put it in your portfolio or not? The problem with putting crypto into your portfolio is it's so volatile. If you're managing your portfolio to any risk target, that volatility has to take something out. And what it takes out is equity. So you put 2% of cryptocurrency in your portfolio, you have to take out, I don't know what the right number is, but 5% of equity. And you don't want to do that. So you have to rethink what type of portfolio you want. And so you do that by adding cryptocurrency to your benchmark. And then you have, in essence, readjusted your risk tolerance. And then you can add cryptocurrency to your portfolio. And then some diversifier, either it's precious metals like gold or cryptocurrency, probably makes sense to be 2 or 5% of your portfolio.
Unfortunately, the Indian investor doesn't have too many avenues to invest, right? Or, as you say, diversify into global assets. What's the option at hand then?
Well, you can do a little bit outside of India, and I think that it's hard to do because the Indian markets have done so well. And my argument for that is really risk-adjusted return rather than absolute return. I'm very bullish on India, so I think India will do well, but you have to look at the risk involved in that. And so it makes sense to be diversified with foreign investments, 10 or 15% of your portfolio. As I also mentioned, you should look at traditional diversifiers, even though, as we've discussed, they haven't been great diversifiers lately. Those traditionals are precious metals or gold or something. And I'm just expanding that a little bit to say that might include digital assets as well. And I think you shouldn't underestimate fixed income as a diversifier of the portfolio. It hasn't always worked, but it has to some degree. We think fixed income returns are basically going to be the coupon over a period of time, but the coupons are pretty good at this point. You can, again, boost that a little bit by diversifying within fixed income with corporate credits or private credits, which we think makes sense to do as well.
So you're basically playing on Buffett's rules. Not earn as much money, but don't lose money, and don't forget rule number 1.
Don't lose money. I think being in the markets for a long period of time, this is a market where everybody's a genius because the market's just going up. And you really find out who's a genius when the markets start to settle. And that's what I'm trying to think about right now. And how do I look at that? How do I tell you really through this whole conversation I'm contradicting myself because I'm telling you that I think the markets are likely to go up and so you want involved in them, but I'm concerned about the risk
not losing
on the downside. And so that's the real struggle. My history is as a value investor, so it isn't often that I have an interview like this where the markets are at a peak and I say, well, there might be even a little more room. So I'm uncomfortable with that, and so I have that sort of value perspective. Yes, but how do I protect myself?
And you think that should be the urgency right now? Don't lose what you've made in this market.
Don't lose what you've made.
So now we're going to play something called the rapid fire. The rules are very simple. I'm going to very rapidly ask you some questions, and hopefully your answers would be full of fire. You just have to be very quick with it.
Okay.
Okay. So your first question is the sector in sweet spot. Your top sector in India for the next 12 months, if you can answer that.
Yeah, I think I'd probably look at the banks.
Banks. Biggest market risk. Biggest risk for India in the near term, would it be geopolitics, valuations, or global rates?
Geopolitics.
Okay. Dollar dominance continues, bullish or bearish on the rupee?
Bullish on the rupee.
Bullish on the rupee. Which comes first, Fed cut or India cut?
Fed cut.
Okay. Outside India, one emerging market you'd be overweight on today?
Brazil.
Okay. You were very, very rapid. Congratulations. Well, thank you, Stephen, for your time.
Thank you for having me.
It was great chatting with you. Lots of insight.
Good.
Thank
I enjoyed it. Thank you.